Welcome, everybody. It's a big pleasure to see you all here, and a big pleasure for me to introduce Tam to come and speak to us. I've heard a version of this talk already 6 weeks ago, and it was interesting enough for me to say, well, why don't you come and do it again here in Oxford? It's a very thought-provoking talk about stuff that wasn't well understood and that we should be aware of before it all, roughly speaking, before it all happens again. I've known Tam for a long time. He's now very senior at the fund, Deputy Director of the Strategy, Policy and Review Department, and wrote this book on a year that he took out on leave at the Peterson Institute in Washington. He has done a number of things at the fund. I remember when you were running more or less the Western Hemisphere and in charge of the US. That's correct, isn't it? And I think after that you took over all the responsibility for the modelling work and the WEO?
The WEO was before. I did the WEO, then the
WEO, then Western Hemisphere, and then modelling. Perhaps that's the logical order. But the real reason that I know Tam is that I taught him when he was an undergraduate in Cambridge. And it's a memorable tutorial because the other person in it was Alan Manning. And these two people taught me quite a lot about economics in that tutorial. But I've probably not told Tam this story, but it's a long time ago. It wasn't very long after Dornbusch's famous exchange rate article that appeared. And Dornbusch wrote a follow-up, I think in Brookings, to that piece, which was slightly loose and not completely tied together. And in the weekly essay, that's exactly what Tam said to Alan and me. And we sat there trying to figure out what Dornbusch should have said in this article. And I ended up getting an MPhil student to write a whole thesis about this exercise that Tam had begun in the tutorial. Well, you remember things like that as a teacher, and we've gone on being friends ever since those early times together. It's a great pleasure to have you back here, Tam.
Well, thank you.
I say back here, that was back there, but now this is back here.
Well, thank you very much, and I certainly remember those tutorials, and I'm very, very glad that I was given the opportunity to come and talk to all of you. It's obviously, I'm going to give a lecture about my book, Unfinished Business. If anybody does want to purchase a copy, there are some over there, and I will happily sign for a mere £20, which is a discount from the £25 on. I guess, well, I'm going to start, by the way, with the really boring bit, which is that this represents my own views, neither those of the IMF nor of the Peterson Institute for International Economics, where I wrote the book. So there we are, I've got that out. So I guess the first question that probably needs answering is, why on earth do we need another book about the crisis? Not an unreasonable question to ask. I will give you two answers to that. The first is, one of the reasons that, although I had the idea about the book some time ago, I didn't write it for some time, was I thought that the full impact of the crisis was still to be seen. And I think, to a first approximation, you can sort of think about things as being pre-2008 crisis and post-2008 crisis. And sort of the bankruptcy of Lehman, in a sense before that, you had a world in which basically people expected a future of prosperity. And there was also a sort of belief that policymakers were in some way, had their finger on the pulse and were sort of adroitly moving the economy in the correct direction. I think after 2008, that's changed. Yeah. I think that people think we're now in a new mediocre. I think the certainty of future prosperity has declined. And I think the belief in expertise has declined. And I think those are very deep social forces, have unleashed very deep social forces, and of course political forces, which we're only seeing the ramifications of almost a decade after the crisis. So I think the sort of, if you like, the impact of the crisis is more obvious now than it was. But the second reason that I wrote this book was that I was actually slightly frustrated with the existing literature. So much of the literature focused on what happened over the crisis, okay? And furthermore, it either focuses on the US crisis or it focuses on the Euro area crisis. One of the things which I argue in my book is that it was a North Atlantic crisis. There was not a US and a European crisis. There was a single crisis which was presented later in Europe for reasons that I will discuss. But there was a single North Atlantic crisis. And what I'm going to argue is that, what I wanted to do was write a book about the origins of the crisis. So most of the books, as I say, were about what happened over the crisis, not how did we get to the state where we could have a crisis. So if you want to take a parallel from the First World War literature, I was trying to write about the origins of the First World War, not the First World War itself, and certainly not focusing on either the Eastern or the Western Front, which you can think of as the US and the Euro area, which, as I say, I think there was a single war, not a... So the story I'm going to tell you starts right back in the 1980s, and it involves serial regulatory mistakes on both sides of the Atlantic, which led to a steady destabilizing in both the European banking system and the US banking system in rather different ways. And I'll get to that. These started, as I say, all the way back in the 1980s. And in fact, by 2002, I argue that the essence of what happened later was already in place. In Europe, by 2002, you had a very large and rapidly expanding banking system. So, and that was what eventually blew up. In the US, you had an equally large and rapidly expanding and equally fragile shadow banking system. And those two things were basically in place by 2002. Then what happened was in 2003, an obscure change in financial regulation by the US SEC brought these two together and actually created a system by which the rapidly expanding Northern European banks went into the US, and they also went into Southern Europe. And that in fact, it was the rapidly expanding Northern European banks which did quite a lot of the financing of the underlying of both bubbles in the US and in Southern Europe. And this is, of course, why it was the North Atlantic crisis, because in the end, the bubbles fed back to the to Northern Europe, where the large banks were, and they destabilized, and that was what made it into a broad crisis. Okay, so that's the story. The story is essentially by 2002, we already had problems on both sides of the Atlantic, and a change in 2003 brought the two together. And to use another parallel from the First World War literature, I think that after 2003, most of the actors were largely sleepwalkers. That most things had already happened by 2003. And all the stuff you hear about CDOs and CDO squareds and rating agencies and loose monetary policy, all of those helped and probably made the crisis bigger. But they were not the cause. The cause was already there by 2003. Okay. So, let me find out if that's what I press. Yes. Good. Okay. So let's start with the European half of the crisis, which is somewhat less studied. So, essentially, what happened was a series of regulatory decisions. In 1986, the Europeans passed the Single Market Act, which at least for the banking system was supposed to create a unified banking system. It failed to do this in essence, because banking is and it tried to make a single banking system by making sure that local regulators couldn't block entry from foreign banks. Now, it failed to do this in the European banking system because in the end, banking, unlike a lot of other industries, is a relationship business. And as a result, if you expand, you always have to take over a bank in the country concerned. So if you're a German bank and want to expand into France, you have to take over a French bank. That automatically meant that the regulators came back in, because in order to take over a French bank, you had to deal with the French regulators. And the regulators successfully stopped most integration. So the Single European Act did not create an integrated European banking system. But what it did do was it created a very pervasive universal banking system. Universal banking system. So the large banks in particular, what happened was they were both doing commercial banking, i.e. doing loans to firms and people, but they're also doing investment banking. Okay, that's dealing in markets. And that banking model, which the large, particularly Northern European banks took over, is called universal banking. And this distinction between commercial banking and investment banking will come back throughout the talk, so it's worth taking account of now. So you had this universal banking model in Europe. Then in 1996, the Basel Committee changed the regulations on investment banking. And what they did was they allowed the international banks, but in particular the European banks, who had this universal banking model, to use their own, bless you, to use their own internal risk models to calculate the capital behind their investment banking operations. Okay, this is called the Market Risk Amendment in 1996. Now, given this opportunity, slightly, not to nobody's surprise, or it should have been to nobody's surprise, the European banks manipulated their internal risk models quite spectacularly to lower the amount of capital behind their investment banking operations and use the additional space on their balance sheet to expand both into investment banking, mainly in the US, which is where investment banking was going on, as well as London, but also into Southern Europe. Okay? So, to get a sense...
Would it be helpful if you just defined in one sentence each, investment banking and commercial banking?
Okay, so commercial banking, as I say, is making loans to firms or to individuals. Okay?
Yeah.
So you make loans to... Investment banking is where you buy and sell assets. Okay? And as we will see, in the US, these two activities were separate. But in the large Northern European banks, such as Deutsche, BNP Paribas, etc., these became universal banks. So in order to see this, here I give you a graph of the size of the European banking system as a ratio of its own GDP. Okay? And it's divided between the rest of the system, which is the blue, and what I call the 12 megabanks. Now, the 12 megabanks are the 12 largest banks in Europe in 2008. Okay, Deutsche, BNP Paribas, I could go through the list. But now, already by 2002, and the reason I start this in 2002, even though the system had been expanding fast before, is because that's the earliest you can get good data on the size of these 12 banks. So already by 2002, the Europeans had a very large banking system. It was their assets were 230% of GDP, right? That is, to give you an example, that is well over double the size of not only the US banking system, even taking account the shadow banking system. It's also well over double the Canadian system, well over double the Australian system. Okay, it was a very big banking system. It was about the same size as the Japanese system, which had already gone through a horrible bubble. What you can also see is from 2002 to 2008, there was almost no change in the size of the rest of the banking system. But the European banking system expanded very, from about 230% of GDP to 320% of GDP by 2008. Okay, so a very large expansion. All of this was the 12 mega banks. Okay, essentially. Now, how did they do that? Well, I was talking to you about the internal risk models. Well, here is a graph showing on the vertical axis capital as a ratio of total assets, okay? And on the horizontal axis, capital as a ratio of risk-weighted assets, okay? Now, this is for 1996. And what you can see is exactly what you expect, since these are two different measures of the capital buffers of banks. And you get exactly what you'd expect, a positive relationship between these two. Okay? If you've got high risk-weighted assets, you've also got high simple leverage ratio, unrisk-weighted assets. Oh, well, that was. That's interesting. That makes it even more dramatic. Here you get this exactly the same graph. And by the way, these are for the 12 banks, the 12 mega banks. These are the dots. In 1996, they weren't all extant, which is why there's not 12 dots. What you can see in 2008 is exactly the same graph. What you can see, though, is that there's actually a negative relationship between the simple calculation of capital as a ratio of assets and the calculation of ratio as a risk-weighted assets. So in this world, you have a universal bank where €1 of capital supports 60 euros of loans is apparently, according to the regulators' calculation, the regulators were using the risk-weighted, is apparently much better capitalized than a commercial bank where €1 of capital supports 12 euro of loans. Now, no prizes for guessing which one got into more trouble over the crisis. Okay. So basically what happened in Europe was this destabilization coming from the manipulation of internal risk models. Now let me switch to the US story. And the US story is also about a series of bad decisions, but rather different ones. So what happened in the US was the rise of shadow banking. So how did this start? Well, it started in the 1970s with the rise in inflation in the US. And what happened was this rise in inflation interacted with caps on deposit rates, which covered the commercial banks. So the US had a very, very different banking structure from Europe. Okay? In the US, you had commercial banks who were under commercial banking regulation, okay, and made loans to people and firms. And you had investment banks which bought and sold assets, which, although they were called investment banks, were not under banking regulation. And this is a huge source of confusion. Okay, but they were not under traditional banking regulation. They were under a much, much looser system. So what happens is, in the 1970s, the rise in inflation interacts with caps on deposit rates, which are imposed by the Federal Reserve, which affect the commercial banks, but do not affect the investment banks. And as a result, the deposits moved from the commercial banks, where they were insured through the FDIC, to uninsured deposits, mainly money market mutual funds and repos, and we'll come back to repos in a bit. Okay, so through the 80s this occurred, and the reason, and here what happened was that the US did in the end get rid of these deposit caps, except for on current accounts. But by the time they did, which was the mid-80s, the damage had already been done, and essentially the deposits had already moved to the investment banks. And the investment banks formed the core of the shadow banking system, because they say they were under much looser regulation. Okay. Now, also in the 1980s, the US not only faced deposit caps, but also various states had caps on loans as well. So again, with higher inflation, what happened was the banks got into more and more trouble. And so you had a whole series of fairly spectacular bank failures. The most famous was Continental Illinois, which went back bust. And the fact that the regulators decided to save the bondholders is the origin of the phrase too big to fail. Okay? And then later on you had the savings and loan crisis. And the reason that you got the savings and loan crisis is, remember the way US mortgage markets were set up, which is that you have 30-year loans on your mortgages, but you're borrowing short, you're borrowing deposits. So when inflation went up, the cost of your financing went up. Meanwhile, there was no change in your mortgage. It's because they were all 30 years. So the S&L got itself into crisis, and essentially a third of the entire industry went bust. One reaction to this, the most important reaction, was that US regulators imposed what was called prompt corrective action. This was a tightening of the regulation on US banks, particularly the capital regulation, and very importantly, it imposed a 5% leverage ratio. So it said that you had to have 5% of capital for every loan that you made. So you had 5 cents of capital for every dollar of loans that you made. Okay. Now this gave the banks even more incentives to, this gave the banks incentives to then save seemingly safe loans to the shadow banking system, to the markets. And this was the origin of the securitization market. Okay. And to show you the transformation in the US mortgage market in particular, here is a picture which shows the US mortgage market in 1980 and in 2002. Now the blue bit are mortgages which are kept on the books of the commercial banks. Okay, and the red bit is mortgages which were sold through securitized assets to essentially the shadow banks. You can see in 1980 the vast majority of mortgages were held on the books of the banks. Already by 2002, well over half of US mortgages were already being sold to the shadow banking system. So this is why I argue that the shadow banking system was essentially in place by 2002. The investment banks and hedge funds and the whole rest of the shadow banking system were essentially taking increasing amounts of deposits, and they were also essentially buying loans from the shadow banking system. And understand, this trade, this securitization trade, had nothing to do with economics. Okay, it wasn't that the shadow banking system was actually better at loans. It was because they had to hold a lot, they didn't have to hold much capital. Okay, so the commercial banks have to hold 5 cents of capital. The investment banks have to hold virtually no capital. So it's pure regulatory arbitrage. The entire securitization market in the US was basically a regulatory arbitrage. Okay, so so this is up to 2002. Okay, so then in okay, I thought I had another slide in here. Let me okay. So then in 2003, what happens is these two halves. So you've got a European system which is being destabilized from the center as the major banks get more and more, have less and less capital behind them. In the US, you get have a banking system which is being destabilized from the edge as the shadow banking system takes over more and more of what banks normally do. In 2003, can
you just say why in Europe it was universal banks, investment banks and commercial banks in together, and you didn't use the word shadow banks in Europe. This is because in the US these two remained separate.
Exactly. So the commercial banking system was under banking regulation
In the US. But you could get rid of it out of it.
And the shadow banking system, which was essentially surrounding the investment banks. The investment banks were the core of the shadow banking system, okay? And what was happening is, because these two bits were separate, the commercial banks were losing deposits to the investment banks and then selling loans to them through securitized assets.
Yeah.
And this destabilized the American banking system because essentially you again had less capital behind, because the shadow banks had very little capital behind. Remember, once you sold the assets, you didn't have to hold, they weren't on the commercial bank's books.
Just clarify.
Okay. Yeah. So then in 2003, the SEC did an obscure change to regulations for US repo market. So repos were a way of borrowing and lending money in a very flexible way. A repo, what I do is I lend you cash, essentially dollar cash, and in return, you lend me an asset with an agreement to repurchase it, let's say a treasury bond or whatever, with an agreement to repurchase it, let's say tomorrow or another week or whatever, at a fixed price. And the difference between those is effectively the interest rate on the loan of the dollars. Okay? Now, before 2003, the collateral that you're allowed to use for repos was essentially extremely safe assets, basically US treasuries. I mean, there were bankers' acceptances and things, but they were really, really safe assets. In 2003, the SEC, under pressure from the investment banks, who were finding the collateral to be much more constrained, expanded repo collateral to two additional types of assets. Well, they expanded them to some more, but two which really matter. The first was all mortgage-backed securities. Okay. This liquefied the mortgage-backed security market. The second was high-class foreign paper. Both of these had very profound effects and, in fact, brought the two halves of the crisis together. So let's start with the MBS side. So here what you can see is a picture of mortgage-backed securities in the US, or as a ratio to GDP, from 1998 through the crisis. Well, you can see, and it's divided into safe mortgages, which are securitized by what are called the government-sponsored enterprises, Fannie Mae and Freddie Mac, and private securitizations by banks. These were much less safe assets, okay, because GSEs would only accept safe assets. They had rules on what they could accept. You can see through 2003, I mean, the private securitization market existed, but it was pretty small. It was about 1/6 of the market. After 2003, after the SEC allows you to use mortgage-backed securities in repos, which liquefies the MBS market, makes it very liquid, right? You get this surge in private securitization. This includes the subprime guys, okay? Much of this is subprime. So this is where the subprime market came from. The fact, and why were people looking for high interest rate unsafe mortgages? Because they were seeing them as traded assets, and of course you wanted the highest possible interest rate security. So what you did was you picked up the private mortgage securities, which had much higher interest rates. So in the US, the 2003 SEC decision started the whole sort of move to subprime mortgages and other risky mortgages.
And one other question, you introduced repos into the story.
Yeah.
Who is lending what to who in the repo part
well,
of this
I'll
story?
come to that in a second.
Okay,
That's the very next slide. The other thing that happened, remember that the other half of this was that the SEC allowed people to use Italian government paper or whatever to get dollars. Okay. So here we have a picture of the foreign assets of the Northern European banks, Northern Euro area banks. Okay? And here it is in 2000 and in 2007. See a massive expansion, particularly into the UK and the US. And by the way, almost all of the UK assets ended up in the US. This is not final destination because it wasn't the final destination for the BIS, wasn't around. And you can see, and then the blue bit is also the assets into the Euro area periphery. What you can see is this massive expansion from 40% of their GDP to well over 80% of their GDP. So what's happening is the Northern European banks are taking their paper, they're using it to borrow dollars, and they're putting the dollars into US mortgage-backed securities. Okay? That is the basic story. In addition, they're also expanding into Southern Europe. Remember that the Northern European banks were expanding like crazy at the time. They're expanding both into the US. Why were they expanding into the US? Remember, they had to put no capital behind, or very little capital behind their investment banking. And where do you do investment banking? You do it in New York. Okay, so there you are. And and they use their dollars to buy dodgy US MBS. And they also expand into Southern Europe. So in essence, as I said, you've got these two halves, which until 2002 were relatively separate. Okay, they were destabilizing, and they were destabilizing in different ways. As I say, in Europe, it was the center of the system which was becoming more fragile, and that's why the harm was much higher in the cost was much higher in the euro area, because it was the center of the system which got into trouble. In the US, it was the periphery, and guys like Bank of America could come in and help, right? None of the major European banks were in good enough shape over the crisis to be able to go and help with the banking crisis. In the US, the commercial banks, by and large, were in pretty good shape. Okay. And then, of course, the finishing touch is the 2003 SEC decision, which creates what I call the cross-Atlantic drift. So you get repos in one way and mortgage-backed assets in the other. So that's the story that I tell of how the crisis came about. Yeah?
One question regarding the repos. You said private MBS served as a better collateral for repos than the GSE middle. Why is that?
It wasn't that it was better collateral. What it was, it was preferred collateral. And the reason it was preferred was that the guys who were doing this were traders, okay? The guys who are in the repo market, they're not in there to hold this for 10 years, okay? They're in here to hold this paper and sell it to somebody in a week, okay? So for them, the best possible asset was a high interest rate asset. And the private mortgage-backed securities had higher interest rates for two reasons. The first was that they were riskier mortgages. Okay, the safe mortgages were done through the government-sponsored enterprises. And the second was the government-sponsored enterprises actually guaranteed the mortgages, so that added a cost and lowered the interest rate. Okay? So that's why people preferred to repo the risky stuff. Did that answer your question?
It's surprising that I thought when you trade, you want to have the collateral that is as safe as possible, because you don't expect to be. You know,
not if you're interested in. You want as high interest rates as you can on what was seemingly a safe asset. I mean, we can also get into the fact that these MBS were rated very highly, and I'm happy to talk about that. I've got a story about that as well. Well, briefly, the reason that they were so highly rated was not that, look, I'm sure part of it was shenanigans between the investment banks and the rating agencies, but you don't need that story, right? Traditionally, the rating agencies had rated things like GM bonds, okay? That's a pretty simple thing, and you just rate it. With these mortgage-backed securities, the investment banks were creating the instruments. So, of course, they talked to the investment banks about how they would rate them, because they had a choice as to how to make the instrument. Okay, and of course, they then exploited the weaknesses in the rating agencies' methodologies. In particular, the big weakness was that at least one of the rating agencies only looked at default, not loss given default. And that's why you ended up with all these what were called waterfall structures, where it was less likely to default, but if you did default, you lost everything. Okay? Because if you're only rating it based on default, that's how you would design an instrument. Now, it doesn't matter for a GM bond, because GM's going to be around anyway, right? But it does matter if you're building a security.
The two GSE slides, or two slides that mentioned GSEs, the first one, which was the 1980 to 2002 development, the majority of mortgages there seemed not to be GSE, but then in the next slide they were.
No.
Is that a sort of stock flow issue?
No, sorry. They're all stocks, because I had various principles, one of which was to always show stocks and always show them as a ratio of GDP. So the previous slide, this is all securitization. Sorry, the GSEs here, that's mortgages backed by the GSEs. That's not, so this is both GSE and private securitizations. Okay? So anyway, but how on earth...
And just before you go on, back to the picture with the map on it.
Yeah.
And can I ask a silly question, except it's probably something that other people won't understand. One more, the nice arrow. Same silly question as before. Why is this called a repo? Why isn't this just European banks investing in buying mortgage assets? What is it that causes it to have the label a repo?
Well, because an awful lot of it was being bought through repos. Some of them bought them. Okay, so the normal story is there are a bunch of sort of very unsophisticated German banks who went and bought a bunch of stuff that they were sold by the US investment banks, okay?
Yeah.
That's the normal story. My story is less about that and more about the fact that the Northern European banks came over and did an enormous amount of investment banking in the US, okay?
Right.
So a lot of them were buying this stuff and as well as trading it. In the same way that the US investment banks, right, when the crisis happened, they were holding an awful lot of the mortgage-backed securities. So were Deutsche.
Yeah. So
were BNP Paribas. So were, all the Northern European... The stuff about the German banks being... the Landesbanken being hoodwinked is true,
sure,
but it's not the main story. Okay. The main story is these universal banks going over and actually operating in the US.
Then I'm still asking a totally trivial question. When you go into your Deutsche Bank, you sit in New York and you do this, what is it that causes it to be called a repo rather than just a purchase of securities? What does the word repo mean that distinguishes it from a normal purchase of an asset?
Okay.
There's a buyback contract.
Yes. Yes, so in a normal purchase, you buy it and you take the risk. Okay?
Right.
In a repo, you buy the asset. A repo is where you buy the asset with an agreement that it will be bought back by the original person at some point in the future at a fixed price.
So this is a particularly risky form of temporary rather than permanent purchase. Okay,
Yeah.
thank you. That's all. It's a semantic question.
Yeah.
Could I just, originally it wasn't, because originally it was the way the Fed ran monetary policy.
Yes.
Right.
That is true. That is true. And in fact, if you look in the US flow of funds, the repos are linked in with monetary policy.
And that's where the name comes from. Its original idea. Yeah.
Yeah, repurchase agreement. Yes, it's a repurchase.
Why is it that European banks are so exposed to mortgage-backed securities and not other cash-rich institutions like the Gulf investment funds?
Okay.
Oil money.
that's a bit of the story which I forgot to tell you. Thanks for reminding me. So, why on earth did people allow the European banks to get quite into this shape? Okay? Because Basel, the market risk amendment was across lots of countries, not the US, because they had prompt corrective action. The answer to this is twofold. The first is most other countries did not have a universal banking model, or if they did, it was not nearly as wide a universal banking model as the Europeans. Okay? So even if they weren't pure commercial banks, the amount of investment banking the banks were doing was limited. So the amount that they could exploit the market risk amendment was limited. So that's the first reason. The second reason is, in Europe, in 1992, the Maastricht Treaty left regulation at the national level. And this baked regulatory competition into the European financial system. Okay? And it was that regulatory competition which meant that everybody missed how fragile their banks were getting. Okay? So what happened was everybody was so focused on backing their own national champions against other people's national champions that the supervisors completely missed that these guys were getting increasingly fragile. Right? So sorry, it's a really important part of the story is that there was all this regulatory competition in Europe which allowed the rot to happen without anybody noticing it. In fact, that's a good question because I'm about to get... So why on earth... So that's the first of what I call the intellectual blinkers. Okay? So how on earth could all of this happen without anybody noticing? Right? I mean, Jesus, you know. So the answer is a whole series of intellectual blinkers. So in Europe, there was the... let's say that there was regulatory competition. But in addition... So there are a whole series of regulatory, of intellectual blinkers, and these did one of two things. They either amplified the costs of the crisis when it came, or they meant that you completely missed that the crisis was coming, or a bit of both. So let me give you a classic the classic amplification mechanism, which was the way that the euro area was designed. Okay, so the euro area was always a debate between the French and the Germans as to how to design it. Okay, and the French and the Germans had completely different views about the role of a single currency. Okay, so the French believed that you needed a single currency to get the integration needed to get a fully functioning single currency. And in the interim, while you were getting that fully integrated economy, you needed to provide support for governments who got themselves into trouble. The Germans had a completely different view. Okay, so the Germans' view was you shouldn't have a single currency until you had an integrated European economy, and that therefore you didn't need to support governments, and indeed supporting governments could get you into trouble because then they would do all sorts of shenanigans. Okay. What you ended up with the Maastricht Treaty, which happens in a hurry because of the fall in the Berlin Wall and the need to bring Germany back into the Western European fold, what you get is the worst of both worlds. Okay, you get a French early EMU with a German no bailout clause. Yeah. That explains why, that's another reason why the European crisis was so costly. Partly it was that the main banks were the ones in trouble, but partly it was that the system was incredibly badly designed for a crisis. Okay? So that's a classic amplifier. Let me give you an example of another intellectual blinker which was both meant that people missed and was an amplifier. And that is the excessive belief in market discipline as a controller of banks, and in particular investment banks. So the Fed in particular, why did the Basel Committee pass the 1996 amendment and allow people to use their own internal risk models to calculate capital, right? Well, the answer was that the Fed in particular was strongly believed that market discipline was the best way to control investment banks taking risks. And that indeed they had a bit of a German, sort of the German view I just described earlier. They actually thought that actually government regulation could interfere with that discipline and might actually not be a terribly good idea. And it was the Fed that pushed the internal risk models. So it's important to understand that these internal risk models, to a very large extent, I mean, it's not quite true, but it's largely true, were actually imposed, at least in the Fed's view, to avoid regulation, not to provide regulation. And I'll come back to that when I come to the lessons from the crisis, okay, and where we are. Okay?
Can I ask just a
Yeah.
clarify? I mean, the other blinker surely is the word competition. I mean, these banks were competing. Well, that's good, at least in terms of the zeitgeist of the day. You're telling us actually they competed by fiddling their risk models and all that sort of thing.
They
It's
did,
very
yeah.
bad.
Yes.
But the degree of optimism that it's the same as market discipline.
Yeah.
That competition plus market discipline was in the air ever since Big Bang and all the rest of it, as the way the thing will go. And you do it well if you're getting a lot of prize of this.
Yes, that's right. And the reality was that this competition, competition ended up, rather than being efficient banks, as a regulatory race to the bottom.
Yes.
That was essentially what happened.
Yeah.
Okay.
It's happened before.
Yeah, no, it's not the first time that we've had a regulatory race to the bottom. In fact, the Basel Committee, of course, I mean, the irony about all of this is the Basel Committee was formed to avoid regulatory races to the bottom. It was formed after, what was the bank that went bust? Sorry? Yes, after Hirschstadt. So another intellectual blinker, as I say, was this excessive belief that that market discipline could control investment banking, and in the end, with Basel II, all banking, since you allowed internal risk models to actually also be on the commercial banking side. Now, this obviously, as I've told you what the story was in the US, in Europe. Of course, in the US, this is why the Fed didn't try and regulate the investment banks, because they didn't believe they needed it. And importantly, it's also why Lehman Brothers bankruptcy was such a disaster. Because understand, if Lehman had been a US commercial bank, you could have done a bridge bank. It would have, even if it had gone bust, it would have carried on operating. Okay, the reason that when it collapsed, boom, that was the end of the repo market, was because there was no provision to keep it going after it had gone bust. Okay. So, you know,
and that's why Goldman's and others in 2 seconds turned themselves into regulated banks.
Absolutely.
For about 6 months after the crisis.
Well, they still are regulated banks, and I'll come to that.
Okay.
They are all the regulated banks now. So the third intellectual blinker was an excessive belief, was an excessive belief in the effectiveness of monetary policy. And this all came from the Great Moderation. So you have this reduction in the fluctuations, particularly in the US economy in the mid-80s. And in the end, the investment bankers managed to convince themselves that the reason for this was because they had incredibly powerful monetary policy and were incredibly clever. And as a result, what they did was they decided that even if there was a bubble, and of course they didn't think there was a bubble, but even if there was a bubble, rather than doing anything about it now, you could pick up the pieces afterwards. A spectacularly bad piece of analysis, as we all now know. Okay, so another blinker was this excessive belief by the central banks that actually they could clean up the problems afterwards. A final intellectual blinker on which I want to spend a bit more time is a belief that the spillovers across countries were small. And the reason for this was everybody was using models in which the only link across countries, or the main link across countries, was trade. And as a result, you know, think about it. let's say I'm trading with you, okay? Now, I may be 40% open or something, but it's pretty unusual for me to send even 5% of my output to any other country unless it's sort of Canada and the US or something. I mean, there are some relationships, but by and large, they're not. So if I collapse, the impact on you is 5 cents in the dollar. It's just not a big spillover. Okay. Now, the odd thing about this belief that the spillovers were small is it was despite the fact that there'd been this whole series of international crises starting in the 1970s, okay, and which, as I'm about to show you, whose costs rose steadily as capital mobility rose in the international financial system. So I've got the 5 here. They are the breakup of Bretton Woods in the 70s, the Latin American debt crisis in the early 80s, the RM in the early 90s, the Asia crisis in the late 90s, and then, of course, the mother of them all, the North Atlantic crisis in the 2008. Now, what I'm doing here, what I'm showing you is an approximation as to what the costs of this were. And I've tried to divide it between the cost to the people involved and then the rest of the world. So, for the people involved, the cost is a fall in growth. So that's effectively a fall in demand and output. For the rest of the world, it's the fall in the current account deficit, because that's a reduction in demand for the rest of the world. Okay? And what you can see is the original Bretton Woods, breakup of Bretton Woods, was actually a very small crisis in many ways. In fact, it's sort of astonishing. It toppled the system, if you look. Then it gets steadily large with the Latin American crisis, the RM crisis, the Asia crisis. And then, of course, by the time of the North Atlantic crisis, you have almost a 3% reduction in global demand, which is a very, very large crisis. The other interesting thing to notice about this is, because remember that before the crisis, the story is always international crises are an emerging market problem. And this is because they were looking from the early 90s on. But look at this, it's an advanced country, then emerging market, then an advanced country, then an emerging market, then an advanced country problem. And I sort of push this view that actually one way of looking at the international, and the MO of these crises is almost identical. Large amounts of debt flowing in, thinking everything's great, suddenly realizing everything isn't, and coming out real fast, okay? And what happens is the next crisis starts forming just as the last one starts getting solved. Okay, so money starts flowing in after the Brady bonds, money starts flowing into Europe, and then you get the RM crisis, okay? So I've got this sort of model where you've got all this debt. By the way, none of these were caused by equity. So equity flows are fine, debt flows aren't, okay? And I've got this sort of model where you've got all this debt slooshing around, and it goes from one place to, it goes and screws up one place, and then just as that place starts sorting itself out, you start into the next place. So that's kind of my model of the international financial system, which I'm sure my employers at the IMF are really amused by. So anyway, that's my, sort of debt looking for places to mess up is kind of a good approximation. Was there a question?
I'm getting a little confused about units because we were alternating between ratio to global GDP and percentages of GDP.
Yeah, here I use the ratio to, global GDP. The interesting thing is, if you want to know why the emerging markets are really worried about these things, if you do it as a ratio of their own GDP, the Latin American and Asia crises are hugely more costly, just simply because the parts of the world are that much smaller. Okay. The reason I did this as a ratio of global GDP is I wanted to show you that these crises have been getting steadily bigger over time as a ratio of global GDP. As I say, there's reasons why emerging markets worry a lot more about these crises, because they really, they mess them up a lot more, and that's in that picture as a ratio of their own GDP is in the book.
By the ERM crisis, you mean the UK being kicked out of?
I mean Italy, the UK, and I include France, because although it got sort of survived, it survived only by essentially, by the time you have an ERM where the bands are 15% rather than 2.25%, you can essentially assume that France was part of the crisis. So France got saved by essentially making the ERM irrelevant. So anyway, that's my story about that. Now to the lessons. So let's start with the US. So the basic story that I tell is one where the real problem in the US was the commercial banks and the investment banks were under different regulation. And that difference in regulation drove growing instability in a shadow banking system that then collapsed. Okay? Well, the US has done quite a lot. The US has essentially solved that problem. Okay? As part of Dodd-Frank, not only did they raise capital ratios, but they also brought the investment banks, so those that are left, which is Morgan Stanley and Goldman, the other three basically went bust over the crisis and were taken over one way or another.
Bear Stearns, Lehman's, and
Merrill Lynch, exactly, who sold to BOA. So the Europeans have essentially, so the US has essentially, the US investment banks are now under essentially the same regulation as the commercial banks. So that particular problem has been solved. Okay, there may be others, but in terms of my history of the crisis, that was the main problem in the US. Europe is much more of a mixed bag. Let's think about the basic problems in Europe. The first was internal risk models that were being exploited. Well, capital ratios have gone up under Basel III, but to this day, the European banks are still only under their own internal risk models. Now, it's supposed to change in 2018, and we'll see how it changes. The devil will be in the details, because we've had regulatory changes before which have not had that much impact because they've been watered down. So we'll see what happens. Okay. The other problem in the European banking system was the lack of the regulatory competition. Okay, across supervisors. Now that's been solved on one level, but it's only been half solved. So the ECB now does supervise all major banks. European banks, okay? So good as it goes. But the costs of the European bank crises are still going to be borne by the governments at this point, okay? So you've got a different set of weird incentives, with the Italian government realizing it's on the hook for the Italian banks, while the ECB, while it's being supervised at a centralized level. And you can imagine what that set of incentives is doing to the European system. If we turn to the architecture of the euro, it's a good news, bad news story. On one level, there are now systems which can be used. There is now a process by which you can provide support to countries in crisis. Okay, but it is only if they're prepared to accept a program. So it's only if they're prepared to accept they are in crisis, which means you're not going to get the early support that might be a much lower cost way of doing things. So you can solve crises now, but you can only solve them once you're prepared to admit you're in crisis. And as we saw in Spain over the crisis, the Spanish were never prepared to admit that. Okay. So how about the intellectual blinkers? Well, on some level, there's been an awful lot of, the efficient markets hypothesis and the belief in market discipline has gone down. Also, there's been an awful lot of work on macro financial linkages, and there's been a certain amount of work also on international spillovers. But to this day, the vast majority of the models which are actually being used by actual institutions that actually make decisions still have omnipotent financial markets, still have very, very powerful monetary policy, and still have small, limited spillovers. So, maybe we will get there. Maybe all this work will turn into something, but at least at present, it's unclear. It's often said that those who do not learn history are doomed to repeat it. What I've tried to do today is tell you a story about the crisis, which says it happened due to a bunch of regulatory mistakes, which were done, albeit done for understandable reasons. So the Fed did believe that market discipline would, and it wasn't a crazy theory, it just turned out to be wrong. And that's true of almost all of the decisions. I go through and I explain why why the regulators made the decisions they did. And in a sense, I think this is actually a hopeful story, because if the crisis was not caused by sort of awful, corrupt people, but rather by sort of mistaken regulation, presumably you can reverse that. Okay. So what I'm trying to do is I'm trying to tell you a story where it's not the standard story of, a bunch of investment bankers hoodwinking people and ripping their faces off, but rather a story by which a bunch of people made bad decisions. Look, I'm not saying there aren't nasty investment bankers, but there always were. I should know, my brother was one.
He still was.
Was. He's now a property speculator, so he's moved up in the world. But they always were. The question is why guys like that were given enough power to be able to really affect the world. Okay. So I think on some level we do have the power to reverse these things. But in order to reverse the mistakes that are made, you have to understand what the fundamental mistakes were, not what the symptoms were. Okay? An awful lot of what happened after the crisis was responding to symptoms, not to deep causes. And that's why I think there's still quite a lot of unfinished business.
Thank you very much. I think we should all